Inflation is dead. The Fed has literally slayed the beast. That's what we're going to talk about today. We're going to talk about the Fed's newest remarks on what they're going to be doing into 2024. Now, we all knew they were going to hold those rates flat, or at least we hoped that they'd hold them. But then they came out and said, we might drop rates 3 times in 2024. I mean, are we seriously going to avoid a recession? Have I been wrong all this time? I mean, shame on me.
No soup for you.
Listen, Biden was saying we were going to soft land the economy, and was he right? Are we going to literally avoid the most painful inflationary period we've ever had since 1981? Because if they drop rates in 2024, that's going to lower borrowing costs, and that's going to be super good for Biden's campaign, right? Oh, hope is such a powerful thing. But it makes me think, does any of this have anything to do with the 2024 election? Does any of this have anything to do with the wars in Russia and Ukraine, the wars going on in Israel and Hamas? None of that could have had anything to do with the Fed's decision, right? I mean, war isn't profitable for the Fed, right? The Fed prints money, US government uses that money and does a bunch of contracts with a whole bunch of companies. I mean, it's not profitable. Never has been, right? What about debt? What about everybody spending all this money and credit card debts reaching over $1 trillion for the first time ever? I mean, just a few short years ago, it was $400 billion, and we were like, whoa! And now it's over $1 trillion. I mean, nothing to see here, folks. No problems. 2024, we're gonna soft land. Everything's gonna be fine. They're gonna drop rates, or at least they might. There's hope, right? They didn't say we're going to drop rates. They said we might. They sort of just opened the door, but they can slam the door in your face. This is what we're gonna have to find out. My name's Chris Naugle. This is What Now? What's next? You know, this Fed's decision of dropping rates 3 times, this actually has me a little bit concerned. I mean, listen, it would be great. It would be great to avoid a recession. It'd be great to soft land this. It'd be great to pull off what would literally be the impossible, the thing that has never before been pulled off in an election year. But you know, when you look at this article right here, it's a bit irrational. It's a bit uncalled for, and it's actually dangerous because they're saying something that may not actually happen, which gets the markets all in a frizzy. And Bain, right here in this article, said that this was a mistake. It was irresponsible of Jerome Powell to actually say this. And who is Bain? Well, Bain ran the FDIC. And Bain's not the only one saying this. There's a whole bunch of others saying that these remarks were completely irrational, were out of line, and they were a big mistake. Because look what it did to the stock market. The stock market has been rallying in optimism of these rate cuts, literally saying, we're gonna be okay. Plow all your money into the markets, put every last penny you can in the S&P 500, which is being held up by 7 stocks, which are highly manipulated, which are highly speculative. 7 stocks holding up the S&P 500. And if we remove those 7, the magnificent 7, you now have a market, an S&P 500, which is negative. Let that sink in for a second. And now we're pushing new highs in a time when the economy is fragile, new highs in the time when Ray Dalio, one of the greatest minds in all of Wall Street, the founder of the largest hedge fund in the world, manages money for the US government and China. He's saying the opposite. He's saying beware. He's saying we've crossed the point of no return. He's saying that the economic machine is on the way down. Oh, but we've got unemployment. That's what they say, right? Unemployment numbers are good. People are working. We just created 199,000 new jobs. Come on, Chris. Come on, Ray. You guys got it wrong. Do we? Because when I look at that report of 199,000 new jobs that were created, I look behind the curtain. Who created these new jobs? Was it real jobs? Well, yeah, they're real jobs, but they're government jobs. They're healthcare jobs. Are they jobs for the local businesses in your town? Are they hiring more people? Is it jobs that actually are real telltale signs of what's going on in the economy? Because here's what I see in the economy, folks. I see things falling apart. I see people barely able to afford to live. I see people struggling to make their bills. As a matter of fact, I don't just see that, the reports show that. We've got default rates skyrocketing on car loans. We got default rates skyrocketing on mortgages. Oh yeah, mortgages are defaulting, or actually people just aren't paying, and you're not hearing about this yet. And credit card debts, that over $1 trillion in credit card debt. Yeah, well, default rates are going up. You see, people just can't afford to make those payments. But it's Christmas time, so like maybe they're just taking a break. Maybe they're just okay, but they want to make sure that they have the money to put on a good Christmas, and I understand that. But you see, the facts are the facts. What you're seeing in the news and what's actually happening are completely disconnected. You see, when you actually look at the data, when you actually look at the reports, the Fred reports and all the other reports, you're not seeing a soft landing. You're not seeing things going good. You're not seeing everybody excited like Wall Street. It's an illusion. But you know what's not a house of cards? You know what's not an illusion? Well, let me tell you. You see that subscribe button right there? That little box that says subscribe? That's not an illusion. That's actually happening, and that actually is something you can click on, and you should. And while you're busy subscribing, see that little bell up there? Why don't you just smash that bell while you're at it? Whoa, came in hot. Yep, that didn't soft land. That thing came in head first. Smash that bell so that we can get on with this show, and so that you can know exactly what's going on, and you don't have to be lied to by the Fed and by what's in the news. Because here's what we're gonna do next. We're gonna look at a little bit of a track history of what the Fed has done in the past. Let's dive in. So let's look at a bankrate.com report. Okay, this talked about the Fed's action. So let me just go through some of the numbers and we'll go back in time. From 2001 to 2003, rate cuts in response to the early 2000s recession, the dot-com recession. You see, that dot-com recession was the first recession that I ever fully felt the impact of. And from that period of time, they dropped rates from 6% to 1%. And by the way, if you hear some banging, some sliding, some clanking in the background, it's okay. We're getting ready to move into our new headquarters, our new offices. More to come on that later. But let's keep going in history, because that's the future. And the future, we're just gonna soft land and the Fed's just gonna drop rates 3 times. Actually, back to it. From 2004 to 2006, post-recession, rates increased gradually, peaking at 5.25%. Then in 2007 to 2008, remember that? Actually, anybody that's 38 years old or younger probably is a bit hazy on what happened during the Great Recession, but I can tell you exactly what happened. I was a financial advisor. Hit the fan. That was the closest we've ever been to a complete and utter collapse of the United States of America's financial system. Yep, so in response to that Great Recession, rates were cut from 4.75% to, drum roll please, zero. And they printed an unbelievable $900 billion. Yeah, back then that was unprecedented. $900 billion, it was literally the talk of the world. It was too much. It was gonna definitely destroy the dollar. It was definitely gonna take us down, because that was just too much money. But it was that or a complete collapse of the United States financial system. You pick. But we moved on. We got through that period of time. Some got hurt more than others. And then that leads me to 2015 to 2018. Do you remember what happened then? Well, I do. The economic recovery that happened actually led to gradual rate increases. You see, the Fed actually tried raising rates and took a bunch of left hooks from Wall Street about doing this until they had to kind of pause that. They couldn't do what they wanted because Wall Street was like a crying little baby and wouldn't let them. So we reached a staggering 2.5%, maybe a little bit more, but that's about where we got. And then 2019 to 2020, all of you watching this should remember that. That's right, the pandemic. And what did they do during the pandemic? They took that interest rate lever and they just click, brought it all the way down to almost zero. There was even talks of them going negative in the rates. They didn't, but that's okay. 2019 to 2020, what happened? We V'd. Everything just bounced around. But let's not forget, and I know this is kind of a secret, but they printed about $5.2 trillion. Remember I said in 2008, 900 billion was like unprecedented? Well, they printed 5.2 trillion. It's party like it's 2020. Everybody got checks. Bunch of money got injected into the central banking systems. Money was being handed out. Yep, little for you, little for you. You want some more? Great. You got a business? Oh, you hire some people? All right, here's some more. Oh, you're actually gonna keep them employed? Here's some more money. Hold on, we'll print a little bit more. Oh, you're actually breathing. Cool, here's a check. What else? You need that new truck? All right, here's another check. They just printed money out of thin air. $5.2 trillion. Yep, but what did that do? Well, that was the response to the pandemic. And they cut rates all the way back, but not only did they cut rates back, they drove the craziest inflationary period that we have felt since the early 1980s. And that leads me right up to 2022 to present. What'd they do? They started jacking rates up. But before they jacked rates up, let's not forget that Jerome Powell and the Fed said, this is just transitory. This isn't a problem. We don't have an inflation problem. This is short-lived. It's going to be short-term. Then they're like, oh, whoops, we made a mistake. This is definitely inflation, but we got it under control. And then they're like, oh, this is getting out of hand. When it peaked over 9%, they're like, we got to take drastic action. And what'd they do? They started jacking rates up, which leads us to where we're at now. They paused rates. And then they hinted, didn't do it. They hinted, they left the door open saying, we just might. I mean, we just want to have the ability to drop rates 3 times. Can I read one more to you? Because this is really important. 2021. I'm going to read this verbatim, and I want you to let this sink in. In 2021, the Federal Reserve Chair Jerome Powell's statements reflected a cautious yet proactive approach toward managing the U.S. economy amidst the ongoing challenges of the COVID-19 pandemic and its economic repercussions. Key points from Powell's speeches and remarks include, and I repeat, we plan to maintain low rates. The Federal Open Market Committee, the FOMC, planned to keep near zero rates for an extended period of time, likely until 2024. Hold on a second. Today is December 18th, 2023, extended period. Okay, and that was to support economic recovery. And, well, might as well throw in a little bit of inflation, a little bit of rising costs. Anyway, let's move on. Economic recovery and monetary policy. Powell acknowledged that the economic recovery observed was due to low rates and other monetary actions. We'll talk about other monetary actions in a second because they haven't stopped that, indicating a continuation of the accommodative policy until employment and inflation goals were met. Inflation goals we haven't hit yet. If I'm not mistaken, earlier we said that the target was 2%. We're not there yet. Unemployment? Yeah, it's looking pretty good. But is it? Hold on. Inflation management. Powell expected inflation to rise above the 2% target. You don't say, Powell. You expected it to rise above? Well, we only got up to 9, so just a little more than the 2% target in the short term. Did you hear what I said? Powell expected inflation to rise above the 2% target in the short term, aiming for a long-term average of only 2%, which he deemed essential for economic health. Missed that one. You see, Powell expressed some optimism. He expressed some optimism about the improvements in key industries and acknowledged and encouraged public health measures to aid economic recovery. Well, let's keep going because I can't stop there. You see, in 2022, there was this inflation and interest rate policy that was set. So in his speech at the Jackson Hole Symposium, where they all fly their jets in, I know the Green New Deal doesn't matter when they got to get somewhere because they all fly their jets in. Powell stated that although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate, and intends to hold the policy at restrictive levels until we are confident that inflation is moving substantially down toward our objective of 2%. This statement highlights the Fed's readiness and continued resolve around rising rates to manage high inflation. Then, neutral rates and economic pressure. Powell referred to the neutral rate, an interest rate that neither stimulates nor hinders the economy. Interesting. To calibrate the Fed's policy rate, the Fed officials estimate the neutral rate at 2.5% as of June 2022, and they made a commitment, a firm commitment, to hold true to their 2% inflation target. Powell affirmed that the Fed's commitment to the 2% inflation target, emphasizing the importance of the goal for long-term economic health. In 2023, Powell noted that headline personal consumption expenditures, the amount of money you are all spending on those credit cards that you're probably maybe a little behind on, he said was projected to end at 2.8% and further fall to 2.4 by the end of the year. Hang on a second. We're just gonna do this real quick. We are December 18th. Where is inflation at today? All right, inflation increased 3.1% in November 2023 from a year ago. So we're going up. Great. Current inflation rate is 3.1%. All right. Okay, so check, got it. They missed. That was 2023. Employment and inflation. The Fed projected that unemployment rate would rise slightly from 3.7 to 4.1, with economic growth slowing from an estimated 2.6 to 1.4 over 2024. Slowing economic growth. These projections suggest a careful approach to managing economic growth and inflation. Careful, like we'll just pause rate increases and we'll just say that we're gonna drop rates and the markets are gonna rally and all is gonna be good and nothing to see here. But 2023 also gave way to something else, and I don't need to read this because I know this well. The Fed made a firm commitment to unwind their balance sheet. Now, let me explain what that means. The Fed holds about, I think it's about $8 trillion in bonds, treasury bonds and mortgage-backed securities. And when they buy those bonds when things are rough. They buy them to stimulate the economy. But now what they're doing is they're unwinding that. They're essentially maturing bonds off their balance sheet. And how much are they doing of that? Well, right now, $95 billion, and that's what it's been. They are maturing $95 billion off their balance sheet. Now, what does that mean for you? Well, that means there's a lot less money in the economy, there's a lot less money in the central banks, and there's a lot less money to go around because they're pulling $95 billion. Now, do you all remember the movie Spaceballs? Check this scene out. This is where the Spaceball ship rolls up to a planet. It was Earth, clearly. And it turns into a vacuum, like a maid, and then they hook the vacuum up to Earth, and they just start sucking all the air out. That's what the Fed's doing right now to the tune of $95 billion every month. They're just sucking money right out of the system, which is why if you haven't been to the bank lately, banks don't want to lend you money. And if you are trying to get a loan, well, good luck. Good luck. They don't want to lend money because there's a lot less money to go around. Does all that sound like everything's smooth and good and that everything's going to soft land? So let's dive into this. What I'm trying to point out is what the Fed says impacts investors like you. So when they make a statement like this and it rallies the markets, you have to use some logic here. Emotionally being driven by your advisors to throw money in the markets, it's all going to be good, because it isn't. See, here's my take. Let me just give you my 2 cents and you can take this for what it's worth. I think the reason the Fed said that they were leaving the door open to 3 rate decreases is because of what I've been saying all along. We're going into a recession. And when we enter recessions, what does the Fed always do? I already told you this. They drop rates. You remember all those time frames? See, I was just prepping you, just trying to bring you up to speed, because when the Fed says we're gonna drop rates, usually that means that it's not a good economic environment. They drop rates when things are falling apart. They drop rates when they want to stimulate growth. But everything's good right now, right? Everything's so freaking good that the markets are at all-time highs, but yet they're gonna drop rates. Wake up, America. They're gonna drop rates because they know we're gonna be in a recession. I don't know all this talk about soft landing, but that's just Biden trying to drive votes. The dude needs some votes. Clearly, the dude's a little behind in the polls. Listen, I'm not trying to make this about politics, but you gotta think that this is about politics. Because when rates go down, Where does money flow? Into risky assets, because they're not being paid like they are today in safe assets like treasury bonds, like specially designed whole life insurance, which actually we'll get to that be your own bank stuff and why whole life is a great place to park money in high inflationary periods and low inflationary periods. It's always a good place because you can put it in there and then you can redeploy that money in investments that you know, like, and understand. But think about this. Think about what's going on. Things aren't good. This is an illusion. If you're putting money in the markets, you are buying high. Make no two ways about it. It might go a little higher, but it's going to go a little higher on complete speculation, not fundamentals. Munger, God rest his soul, is probably rolling in his grave right now. He's probably sitting there saying, that son of a pup, what the hell is he thinking with this statement? That is irresponsible. He's saying the same thing Bain is. But he's no longer here, but Warren Buffett is. So you might want to actually look at where the wealthy have their money right now, because it isn't the same place you have your money. The wealthy don't have all their money in the S&P, the NASDAQ, the Dow Jones, those indexes. They don't have their money in IULs, that much I can promise you. Where do the wealthy have money? Sitting on the sidelines. Google it. Right now, Google Warren Buffett's portfolio for Berkshire Hathaway. How much money is he sitting on in cash this year versus how much he had last year? How much did he have last year compared to the year before? What you will see is that it's more, and more. Why would Warren Buffett have money sitting in cash? Might it be because he's waiting for a buying opportunity and all he's doing is waiting for the Fed to be irrational and start making statements like this because he knows where we're headed? And not only that, I almost forgot to mention all this foreign aid, all this money printing that's going on to fund wars. Whose wars? Well, they're not really ours. Are they our allies? Yeah, in some sense. But I really want you to think about the potential of war in the future. War is profitable for the Fed. The Fed prints money, has the unlimited printing press, gives it to the US government. The US government goes out and hires contractors to build tanks and planes and guns and ammo and all the stuff that comes along with a war. That's usually pretty good for an economy. So if rates are going to go down, that probably means we're not going to be in a good place next year. But sure does make everybody pretty excited about voting. Yeah, maybe that's the dude's plan. I don't know. But it makes you wonder whose side the Fed is on. Is the Fed on your side? Or is the Fed playing a different game? And is the Fed in bed with the dude? I don't know. Is the dude even making the calls? I don't know. Does the dude know where he is? I don't know.
Repeat the line.
There's a whole bunch of I don't knows, but all this information that I just gave you points one place. You are being lied to. You are being led off of a cliff. You know, I never quite understand why people do the things that they do. They literally follow people and they can't answer why they follow the masses. So if everybody's investing in the markets and I ask somebody, hey, how come you're investing in the S&P 500 at all-time highs? They can't give me an answer. Oh, because that guy told me. And then I asked that guy, and that guy says, because that guy told me. And that guy says, no, that gal told me. And that guy, that gal says, this person told me. And that person, we don't even know why we do things anymore. We just follow the herd. And you know what happens? You follow them right off the cliff. And that's not something I want any of you to have to go through. Oh, by the way, not to toot my own horn, but you remember what I was saying about treasury bonds? I wasn't making recommendations or giving financial advice, but you know, I've been putting a bunch of money in treasury bonds. And you know, when the Fed came out and said that they were thinking about maybe dropping rates, what do you think happened to the price of all those long-term treasury bonds that I bought? That's right. Big thumbs up. I mean, it went way up. We have gone up tremendously just in the last week. It's been a good day here in the office. It's been a good day for any of you that bought those long-term treasury bonds because you're seeing the impact. When rates go up, the price goes down. Great time to buy. And when rates go down, the price of the bonds goes up. The complete opposite of what is happening in Wall Street, in the Magnificent Seven, in the S&P 500, in the Dow Jones. That is a dangerous place to put your money. You see, you don't want to buy high. You want to buy low. And you want to sell high, which means you should be selling now, not buying now. But clearly, if you're buying and your advisor's telling you to buy, you're just following people that can't even tell you why you should be buying right now. The house of cards always comes crumbling down. So in conclusion, what are the actual damages of this rate flip? What does it actually mean? What is it going to mean for you? Well, I think these are the most relevant questions. And I can't really tell you what it means, but I can point you in the direction like I just did. But what it does mean is it means this is the best time in your life for you to take back control of your money. This is the absolute best and most critical time of your life for you to become your own bank and take back control of all the banking functions in your life. Yes, I am talking about the infinite banking concept, the process of you taking back the banking functions in your life. This is sincerely the most important time ever for you to do that. Because the best return you can ever make is to pay off those credit cards using the infinite banking concept and then just change the name on the check. Every check that you write to those credit cards, which are 20, 25, 30%, that's the return you should be getting on your money, and it's simple to get. All you do is you pay the credit card off using the policy, and then you take the money you used to give the credit cards and you pay it back to the policy. So take a look at the other videos by subscribing and clicking that little bell. And also, one final thing. If you've liked this video, you gotta check this one out. I call it 2025, a look back from the future. We'll see you on the next one. This has been another episode of What Now, What's Next. See you soon.